Loan scenario problem number 2, unverifiable self-employed income. Borrower name in this case is Michael B. The situation is that Michael is a first-time homebuyer who works as a salaried teacher earning $4,500 per month in gross income. He also has a side business as a tutor bringing in an additional $1,000 per month, but this income is not documented on his tax returns, so it cannot be used for qualifying purposes. But Michael wants to purchase a condo priced at $250,000, putting down 10%, or what would be the equivalent of $25,000, and financing the remaining $225,000. His current monthly debts include an auto loan, which is about $400, and a student loan of $200. Michael is concerned about whether he can qualify for this loan while keeping his debt-to-income ratio, or DTI, within the required 43%. Now, when we say within, this basically means it needs to be under 43%. Depending on the situation and the loan program, this might be 45%, 40%, 50%, 57%. It just depends on the loan program and the lender and their guidelines. Number 1, we're going to determine the monthly mortgage payment. Using a 30-year fixed loan with an interest rate of 6.5%, we're going to calculate the monthly principal and interest payment for a $225,000 loan. Now, again, you're simply going to use a mortgage calculator, or you can do that by going to Google and then entering mortgage calculator and then inputting these figures: 30-year fixed, 6.5%, and the loan amount of $225,000. And this is going to give you a monthly principal and interest payment equal to $1,423. Then we need to add HOA payments, or homeowners association fees, property taxes, and insurance. In this case, we see that the monthly HOA fees for the condo are $200. The annual property taxes are $2,500. Now, we do need to convert that on a monthly basis, so we divide by 12 and we get $908. If we do the same exact thing for his annual homeowners insurance, we're going to divide 900 by 12 and we're going to get $75. Now, the total monthly housing payment, if we add everything together, is going to be $1,423 plus $200 plus $208 plus $75. And we're going to get $1,906. Just to make sure you understood, all we're doing here is we're adding the principal, interest, taxes, and insurance, which would be the PITI, and then we're going to add the homeowners association dues. So this is commonly known as PITIA, okay, for association. Now that we have these numbers, we're going to go ahead and add any monthly debts. Now remember, he had a total of $600, and we're going to take that total and we're going to add it plus the PITIA, which was $1,906 plus those $600, and we're going to get $2,506, which is what we need to know to calculate his DTI. Now, let's calculate the DTI using Michael's gross income. His gross monthly income is $4,500. For qualifying purposes, always remember we use the gross monthly income, not the net. Now, the DTI, or the equation for calculating the debt-to-income ratio, is the total monthly obligations divided by gross monthly income times 100. So we're going to get $2,506 divided by his gross income, $4,500 times 100, and this is approximately 55.7%. Michael's DTI exceeds the required 43%, so he does not qualify for this loan. Now, I want you to pause the course lecture and try to find a solution. Right now, he doesn't qualify, but if you're not sure, you can simply continue with the course lecture, but I want you to try to think of possible solutions, even if they're out of the box, they make no sense, or if they simply aren't something that you think would be possible, but you never know. So let's see what we get. And if you have another solution different from what the instructor has, that's perfectly fine. It's normal. There are always more than one way to solve one of these mortgage problems, so don't worry about it. Loan scenario solution. To get Michael's loan approved, we use the following strategies. Number one, student loan payment adjustment. Michael was on a standard repayment plan for his student loans, but after consulting with him, he switched to an income-driven repayment or IDR plan, reducing his monthly student loan payment from $200 to $50. Revised monthly debts, excluding mortgage, now are $400 plus $50, which equals $450 instead of $600, which was what he had before. Number two, we're going to use an increasing down payment. Michael had access to additional savings from a gift fund provided by a family member, which means one of his family members gave him a gift of funds that is perfectly allowed when it comes to the mortgage industry, okay? Just depends on the loan program, but most loan programs are fine with that. By increasing his down payment to 15% or $37,500, his loan amount reduced to $212,500. Using the same formula with a 6% interest rate, the revised monthly principal and interest payment is now $1,343. And then if we input that back into our equation to calculate the PITIA, which would include the HOA, taxes, and insurance, we're going to get a total of $1,826. So now, if we add that plus $450, we're going to get his total monthly obligations, which would be $2,276. Recalculating the DTI. With the revised obligations and income, we calculated the new DTI, which is now $2,276 divided by $4,500 times 100 equals approximately 50.6%. Michael still exceeded the traditional DTI of 43%, okay? But this actually allowed us to explore compensating factors to close the loan. Now, what are compensating factors? Compensating factors can be anywhere from having a really good credit score to coming in with a high down payment or having a large amount of savings that the underwriter or the bank can actually use as a compensating factor, which will allow the borrower to still move forward with the loan. So in this case, we utilized a non-QM program with his side income updated from a monthly overview account, and a non-QM loan program compensating for Michael's slightly higher DTI was approved as he showcased stable full-time income. So the loan in this case resulted as closed or approved, and then it eventually closed. That's how we solved this specific loan scenario problem.